You thought a weak jobs report would force the Federal Reserve into rescue cuts. But today's market is telling you it's not that simple. The U.S. economy lost 92,000 non-farm jobs in February, and the unemployment rate rose to 4.4%. January retail sales also slipped 0.2% month over month. That is real weakness. But the Federal Reserve is not looking at labor data in isolation anymore. Oil just surged as the Middle East war intensified, and that changes the policy equation immediately. Trump demanded Iran's unconditional surrender, and crude exploded higher. U.S. crude settled at $90.90 a barrel and Brent at $92.69, with Qatar's energy minister warning that a prolonged disruption could send prices far higher. That does not guarantee a lasting inflation spiral, but it does mean the Fed cannot treat this jobs miss as a clean excuse for aggressive easing. Markets still largely expect the Fed to hold in March, while debate shifts toward whether cuts begin later, possibly in June. There is one more nuance. Today's jobs decline does not automatically prove the labor market is collapsing. The BLS said healthcare strike activity helped drag payrolls lower, and Reuters also reported winter weather was a factor. So the signal is weaker growth, not yet a confirmed breakdown. Now look at AI infrastructure. The Oracle and OpenAI Texas story is real, but the original version overstated the cause. Reuters reported that the two companies abandoned a planned expansion of the Abilene site after financing talks dragged and OpenAI's needs changed. Existing construction is still continuing, parts of the site are already operational, and a separate 4.5-gigawatt data center plan remains on track. So this is a warning about capital discipline and execution risk, not proof that the entire AI build-out just hit a permanent physical wall. That said, the grid problem is still real. Reuters separately reported that U.S. data center growth is increasingly colliding with power system constraints, and new rules are favoring projects paired with on-site gas generation. That raises capital intensity and infrastructure complexity across the sector, even if it was not confirmed as the reason for this specific Oracle decision. Credit markets also flash stress. BlackRock limited withdrawals from its HPS corporate lending fund after repurchase requests reached 9.3% of shares outstanding, above its 5% quarterly framework, with about $620 million set to be paid out. But the original claim that financials dropped 7.7% across the board was too strong. Reuters reported BlackRock shares fell about 6.7% to 7.1%, while the S&P 500 Banks Index fell 2.03%. That is still meaningful stress, just not a universal collapse. So the cleaner takeaway is, this labor is softening, oil is spiking, and the Fed is caught between growth risk and inflation risk. That is the stagflation fear. But today's data does not prove that free cash flow is already gone across corporate America, and it does not prove the energy shock is permanent. In fact, Reuters reported that oil derivatives are still signaling traders see this as more of a near-term supply shock than a long-term structural repricing. Monday, watch the 2-year Treasury yield, front-end inflation expectations, and energy-linked credit spreads. If those keep rising even after weak labor data, that tells you the market is repricing inflation risk faster than it is repricing recession risk. Reuters reported U.S. 2-year yields rose 16 basis points on the week, even after the jobs miss, which shows how seriously the market is taking the oil shock. This isn't financial advice. Keep your eyes on the margins. I'm Wilson, and I'll see you tomorrow.